we look at your question number 3, the case study based on the pre-scene discussion. I am believing that you would have gone through the pre-scene which was discussed earlier. So, you could check that pre-scene while we look at the unseen. The pre-scene knowledge is very important because there are a lot of connectivity to the pre-scene. So, going to look at the question number 3, section 2, that is 50 marks question. They say the chairman of the CAPL has been working with the Blue Rock Capital to issue 20% more shares immediately as the company would experience liquidity problem due to a rapid change in the macroeconomic conditions in Sri Lanka. The chairman summoned a meeting to address some of the concerns raised by BRC and decided on an issue price for the 20% of fresh shares. So, you could go through the extracts of the board meeting where they say BRC has queried the acceptability of the 5-year forecast prepared by CAPL and has requested to revise it based on the recent developments. So, I am sure I could have gone through the pre-scene that basically 5-year forecast has been given in page number 9. So, when you look at it, just for understanding that you have to look at your pre-scene 5-year forecast where the 2023 to 2027 the revenue to P&L profit has been estimated by the company. So, the unseen, what we are told, basically due to the economic changes, as you know in Sri Lanka, this is your July paper. So, the July onwards or maybe little later, you would have seen there are a lot of changes in terms of the macroeconomic picture. The interest rates have gone up with very high levels, like it was like last year November it would have been say 7-8% levels, has come to now almost 30% today's context. So, that is a huge change in the interest rates environment. Then the inflation rate had been maintained or not maintained, that had been going at 70% levels. Then rupee depreciation, which of course happened in March 2022 onwards. So, the depreciation or devaluation happened to Sri Lanka rupee from 190 levels to 360 levels. So, you could see there are huge changes in each of these variables in the macroeconomic picture. So, the examiner said the pre-scene, even though you have done for 5 years in the forecast, you have done it for the pre-scene, which needs to be revised looking at the present economic conditions. So, they say the CAPL anonymously agreed to revise the forecast and the CFO of the CAPL presented the following projections received from the market research firm. Rupee depreciation again dollar 22-23, that is next year, 40% depreciation of rupee, and 23-24 they say 20% depreciation of rupee. Incremental change in treasury bill rate, 7% increase in 22-23, 23-24 by 5%. So, they are given comparatively lower rates for the interest rates, but then you should know that the realistic picture is further worse than what is mentioned in the case study. BRC is of the view that value of the 20% fresh shares should be calculated based on either of the cash flow based valuation, based on revised forecast, or the price earning ratio method by the benchmarking a similar company. So, the two valuation methods, they are talking about free cash flow based method and the price earning method using a similar company in the market. CFO disagreed with the market based valuation, but instead he supported the free cash based valuation as the best valuation method under any circumstances. Please underline the sentence called under any circumstances. We all know that under valuation methods, the free cash flow method is more comprehensive, more detailed and more fair value for any company. Especially when you are looking at it from an investor who wants to buy the controlling stake in a company, the free cash flow method of valuation is more ideal method of valuation. The second would be the price earning ratio. That is another method of valuation and which is more reasonable in terms of fair value valuation compared to your net asset based valuation or the dividend cash flow based valuation. But we should know that today the context is totally different from a normal environment. So the business environment is totally different. Why? The interest rates have gone up tremendously. Inflation has gone up by 70% compared to last year. So which we do not know what will happen over the months to come. And the interest exchange rate, Sri Lanka rupee depreciated or devalued almost 70-80% over the last few months. So this basically shows that the environment is different, totally different. And the forecasting the future cash flow is not an easy thing. Why? These changes, we do not know whether that will be continuing for some time or that will change. Optimistically, when we want to look at it as a country and citizens of the country, we all like to see a change or the reversal of these changes. That is, the interest rates to come down over the period and inflation should come down definitely, significantly, and the exchange rate depreciation which happened because of the lack of or the basically insufficient dollars in the country, where the country was short of dollars because of the COVID problems of the 2-year period, and then the remittances dropped into the country, tourism dropped. So all that had a negative impact in our foreign currency reserves, and then we basically came to a zero levels in the sense like we can't manage our imports with the exports proceeds only. So the government came up with many controls, restrictions in terms of imports. So that basically pushed us to getting into queues in the country for certain products, right, fuel and the cylinders and stuff like that. And in addition, there were shortage of medicines and some of the essential goods because of the dollar shortage. But then over the period, slightly there is improvement in the dollars because of the import controls and the restriction placed by the central bank and the government. We were slowly able to manage to get some of the necessary products or the essentials without much of a difficulty. But still, the situation is not that normal because still the import restriction continue and we do not have a significant growth in our earnings or remittances, even though it's slowly picking up. The tourism is picking up, but it's always the growth will be marginal or the slow growth. So we should know this overall macroeconomic picture when you are looking at this case, where the free cash flow based valuation, according to CFO, he said he is disagreeing with the market based valuation, but instead supported the free cash flow valuation as the best valuation method under any circumstances. But his thinking is not normal situation, it could be fine, but in the present economic situation, the free cash flow based valuation may not be the right method of valuation. We will discuss that in detail later. So the 2 years forecast needs revising due to the exchange rate variation and the interest rate variation and the inflation variation. So the board of directors agreed to hire a consulting firm, PQR consultants for evaluation purposes, and CFO was requested to provide the necessary information for this task. Given below is the information is shared with PQR. Incremental change in general inflation would be 20% per annum. Incremental inflation is 20% for 22-23 and 27% would be applicable 23-24. So both years you have inflation. Please understand that the inflation is the price of goods and services are increasing compared to the previous period, right? So that has gone up by 27%. In 23-24 and 22-23 it's a 20% growth. So there are inflation in both years in addition to the exchange rate depreciation and the interest rate increase. Existing forecasts are prepared with fixed exchange rate of 200 per US dollar and it will increase. So the company increase the selling price by 25% and 17% for 22-23 and 23-24 respectively. So in order to counter the inflationary effect in the country, the companies always would like to increase the prices. So if your products are, you have bargaining power as a seller or the company or businessman, you are able to increase your selling price and pass on the inflationary effect of your cost or the raw material and your purchasing price to the customers, so that the company will not suffer. It's the end of the day, customers will have to pay extra costs. So here again they have increased the inflation impact, they want to counter effect So they basically increase the selling price by 25% and 17% for 2 years. So as you know that in response to general inflation expected, this has been done, but which is applicable only for local sales, only local sales. And they have given you the composition of the sales, export sales in dollars as a percentage of total revenue, 25% and 25% for both years. Whereas the distribution expenses incurred in dollars as a percentage of total distribution is 30% and 30%. So this is a composition of your expenses of distribution and the export sales. So we'll come to that in detail. Corporate income tax 28%, that's your government is taxing you 28%, whereas average effective tax rate on profit before tax is estimated to be 15% on average. So please note that even though the tax rate is 28%, your effective tax on your profit before tax in your P&L, when you convert or calculate your tax amount against your profit before tax, which is 15% on average. Free cash flow reported at the end of the 2023-24 would increase 9% per annum in perpetuity. This is your terminal value calculation, your cash flows growth is given. Then they have given you the share price movement. Your company share price in 2021 is 380 rupees, which became 135 in 22 March and 26 April 96. So you could see a significant drop in the share price. This is another macroeconomic picture where the share market started moving downwards because these overall economic conditions are not good in the country. So please understand they have given you a all share price index movement as well as the SPA Lanka, which is a competitor company information where they say the market price how it has moved. Then they have given you at the subsequent meeting following matters require urgent attention were discussed. Short and medium term financing, matter 1, discussion with SPA for the investment of 20% CAPL shares, that is number 2 or the matter 2. Then the follow up on IPO. Now we go to the question. A part 7 marks they are asking, assess how the 5-year forecast which is given the pre-scene would be altered or would be changed to incorporate the changes in the macroeconomic conditions in Sri Lanka by deriving the revised forecast income statements of CAPL for the years ending 22-23 and 23-24. It's a 7 marks question where the examiner wanted you a revised forecast for 2 years. Revised forecast for 2 years because they have given you the changes in macroeconomic variable for 2 years. So can we look at the suggested answer? So we need to first look at the sales, the revenue amount, so how this will change. Your 3769, 4146 is in your pre-scene sales for both years. These are total sales. This total sales has 2 components, export sales and the local sales. They have mentioned in the unseen, export sales contribute to 25% and the local sales contribute 75%. So this 3769 and 4146 we can calculate 25% and 75%, which is the component of your sales, local and export. Then you need to know that the sales what had been accounted is at the rate of 200 rupees. So the forecast has been calculated at the 200 rupee exchange rate. That was the rate at that time when you forecasted. But we know that due to the economic changes, the rates have changed or Sri Lanka rupee had depreciated significantly against dollar. So the dollar rate or the rupee depreciation has been given as first year, that is 2022-23, 40%, and 23-24 it is 20%. So the rupee depreciation had been given. So what we have to do is we need to find the revised dollar rate or the rupee equivalent to dollar. That is 280, 40%, that is 200 rupees into 40%, 280. Then you get the 20%, 56 rupees exchange rate depreciation with the 280, 336. So that basically shows the new revised rupee rate, rupee against the dollar. Now we need to calculate the revised revenue. So please note that there are 2 aspects to it. One is for the export sales, your base dollar rate or the rupee equivalent to dollar as revised to new rates. But local sales, you are increasing the price by 25% and 17% for both years. So you need to look at your local sales amount will go up by 25% for first year, second year for 17%. So the amount has to be inflated by 25% for first year. Second year, you need to calculate the 3,110 into 25% and into 17%. Why? The 2-year inflation has to impact your sales for the 2024. Export sales, you have got your rupee value, but this was revised or it was calculated at the 200 rupee exchange rate. So you divide by 200 and you get the dollar in millions. Then you calculate at the new exchange rate how much your export sales is going to be. So this is your revised revenue for 2023 and 24. Then the distribution expenses, similarly like your expenses or the export proceeds, you need to understand that your distribution expenses is given in the 943 and 1036 in the pre-scene. So this is also again you need to find out what is the local component, what is the foreign component. So 30% foreign, local 70%. Similar exercise for export proceed what we did, you divide this foreign component by 200 so that you get a dollar terms how much you are incurring on distribution expenses. That dollar term amount you multiply with the new dollar rate which is 280 and 336 what we calculated earlier, you can multiply and then get your rupee amount of distribution expenses. Similarly, your local distribution expenses like your local sales will go up by 20% and 27% for respective years. So that inflated distribution expenses is calculated here. So we get now 1188, 1627 instead of 943 and 1036. This is your distribution expenses revised. So we got the sales revised, now the distribution expenses revised. Finance cost, as per the suggested answer, we do not revise because company has obtained bank loan at a fixed interest rate. So we all know that if the interest rates are taken on a fixed interest rate environment or basically your contract is fixed interest rate contract, you don't have to worry about even if the market rates go up, you do not worry why your contract loan agreement will say that your loan has to be paid according to fixed interest rate which is already agreed at the time you took the loan. So therefore the finance cost will not change because you have taken a fixed interest rate. This is a 2-year period we are talking. Then the revised forecast, you can see that year 1, year 2 or 23 and 24, your P&L which is in the pre-scene, this is the pre-scene P&L for both years. With the working what we looked at, you can see the revenue has gone up because of the working one we have looked at, that's export proceeds have increased because of rupee depreciation and the local sales have increased because of the inflationary impact we have basically transferred to customers. So this is your sales and then you maintain the cost of sales will go up at the 20 and 27% inflationary impact because definitely it has to be increased or it's increasing. So you calculate your GP, then the other operating income will leave it at 66. We do not have impact, we are not taking into that consideration because small amount. Research and development, you have inflationary impact again, that is also you have to estimate the new revised expenses. Distribution expenses we calculated earlier. Admin expenses, again a 20% impact has to come and the 2 years of inflation impact has to come. So that basically gives you the admin expenses. Finance income, we have not revised it because it's very small amount, negligible. Finance cost, we have taken the same amount because as I mentioned, you have taken a loan on the fixed interest rate basis, so no change in your cost. So net finance cost, then profit before tax, then you are talking about your effective tax rate. Effective tax rate is given at 15%, so that is 42 against 280 million. So that basically gives you the profit after tax 238 and 127. This is a 7-marks question of the revised forecast only for 2 years. They are not talking about all the years, only 2 years, and the changes whatever is prescribed is very clearly given. What's happening to exchange rate, what's happening to inflation, what is happening to the distribution expenses, all that is given. Only the trick here is that dollar-based sales, dollar-based distribution expenses. So that is to be calculated first, then you need to make sure that that was valued at 200 rupee exchange rate, whereas your exchange rate has changed now. So your revised cost or revised income will be based on new exchange rate. So that's basically 7 marks question. Then the B part, it's about the valuation. It's about the valuation. The CFO of the CAPL needs your support in evaluating other valuation methods in addition to free cash flow based valuation method. So he is asking free cash flow and market based valuation are the methods they talked about. Apart from that, what are other valuation methods you may use? So determine, the question asking us, determine the value of CAPL shares based on 4 valuation methods by recommending a reasonable price range for the 20% fresh share issue, and explain whether you agree with the CFO comments on the superiority of the free cash based valuation method over the market based valuation method under any circumstances. I earlier wanted you to underline the sentence, any circumstances. Mention any assumption you make. 25 marks. 25 marks valuation area. Valuation area, if you master, really you will definitely get through exam, because that's basically the basis for most of the other syllabus area, which will give you very good knowledge on financial management. So when you look at this question, 25 marks straight away for the valuation question. So when you look at the suggested answer, before we get coming to the so we will look at different methods of valuation, right? We know that free cash flow based valuation is definitely used in valuing a company because it's a comprehensive method of valuation, but we have reservation in terms of free cash flow method, especially when it comes to a country's situation like ours today, where the macroeconomic variables, most of the macroeconomic variables are in a very challenging levels. That is, inflation is at very high levels of 70%, interest rates are at 30%, and then your taxes have changed. Today's context has changed, taxes are changed, and even interest rates are very high compared to the case that we are talking about. And your exchange rate has depreciated, Sri Lanka rupee depreciated significantly. So how this will impact your valuation? We will come to that. So when you go to the revised profit from operation, 322 million and 193 million, that is working number 3, you could look at it. So you can look at their profit from operations, that is EBIT, profit from operation which is EBIT, revised 322 million and 193 million. So profit from operations which is EBIT, you can see that it is 322 million and 193 for 2 years, 2-year period. So that's basically the starting point for your free cash flow valuation. So you can see 23, 22 and 193. Then we know that free cash flow valuation, we take the working capital changes. So you could look at it, changes in working capital, working number 5. You could see the changes in CA, that is the current assets except cash, and changes in current liability except overdraft. So when you take it, you have your net working capital, the amounts are given here, 22, 21, 22, 22, 23. Then you see the change, because change is the amount you are requiring to find out of my free cash flow how much I am investing on working capital, how much I am going to invest in working capital, because that's the only change, incremental. You are not going to look at your balance sheet and this is the working capital I invest every year. No, only the change in your working capital you invest. So free cash flow valuation point of view, we only look at the change in your investment or changes in your working capital. So please look at, this is the working capital change, current assets and current liability, but there is an inflationary impact that we have to consider. So we have taken 20%, in the first year it's only 20%. So based on that, your working capital investment will be 178, 176 for current assets and current liability. Same approach for 22, 23, 23, 24. You can look at it, similar way of calculation where you calculate the working capital change for both current assets and current liability. But please note that there needs to be an inflationary impact, because your forecasted P&L or balance sheet is based on your earlier inflation environment, but now we are talking about the inflations have gone significantly, so we have to revise our investment in working capital. So based on that we have got it. This is working number 4, working number 5. You can see that both investment in working capital, current assets and current liability had been taken for both years. Then net impact on depreciation and capital expenditure, working number 6. So working number 6, if you go to changes in depreciation and capital expenditure, you can see both years the change in depreciation and capital expenditure, how much your net movement in your capital expenditure. This is 93 and 29. So which is taken for you to calculate your free cash flow based valuation, 93 and 29. Tax payment, working number 7. You can see the EBIT what we calculated earlier, 322, 193, and we assume that 15% of that EBIT is basically liable for the company to be paying as tax, that is 48 and 29 million. Then you calculate your net cash flows for year 1 and 2 or 22, 23, 23, 24, 366 million, 80.4 million. Then what we do? We calculate terminal value. Where terminal value is for the balance cash flows for perpetual, working number 8. You can see the 87.64, the WACC, we need to calculate WACC, we will come to that. Then you calculate your terminal value. So how do you calculate WACC? You have been given, or you are asking to calculate the computation of cost of equity. The unlevered beta, I think the preceding discussion we had, right, you would have calculated your, in the preceding discussion we talked about our CAPM level, right, we can use a CAPM model and we calculate the cost of equity. So ungeared beta which is 0.90, preceding also we discussed and we calculated, 0.90 for this company, this is a company, this is based on the company we calculated the asset beta, unlevered beta is asset beta. From there we calculate what is this company, CAPL, what is the levered beta based on their gearing. Based on their gearing it's 1.07. So because the tax rates we have to take 28% as per the unseen material. The pre-seen level we have taken at that time it was 14%. So unseen material says the tax rate is 28%. So based on that 1.07 is a levered beta. So if that is the case, your risk-free rate, please note that they have said that 2-year period the risk-free rate is going to change by 7% and 5%. The given rate was 7.9 at the pre-seen level, but then 2 rates they have given you that incremental interest rate 7%, 5%. So that gives you a 19.9, almost 20% your risk-free rate. And the risk premium is given as 8%. 8% is given in the question. So you take that and levered beta 1.07 what you calculated. Then you get the required rate of return which is approximately 28%. So based on that we calculate your WACC. So you can see the WACC computation. So based on that you see that WACC is 25%. So you have a equity component 79%, debt component 21% based on the 5-year forecasted balance sheet, and your cost of equity 28% what we calculated using CAPM model, cost of debt is 13.7. So you get these after tax, and then basically we are talking about 25% WACC. So based on that WACC 25%, the weighted average cost of capital is at 25%. You calculate your present value of the cash flows which is coming to an enterprise value of 695 million. So this is your free cash flow based valuation, 695 million. Then we minus the loans and borrowing which is 681 million. Loans and borrowing which is 681 million. So basically that is given. This is given in your balance sheet or the pre-seen 681 million. So basically we add back your cash and cash equivalent in order to calculate your equity value. So you get 192.6 million equity value 192.6 million total equity value, and 20% of the shares we are going to issue, so we get 38.5. This is based on the free cash flow based valuation, based on the forecast, revised forecast. Our value of the company, 20% value of the company is 38.5. Then the market based valuation, peer company which is given as Spa Lanka, right, peer company, earning per share 45 rupees, market price per share 135 rupees. So I think at the pre-scene level we calculated our PE ratio is 3 times. So P in the market is 3 times, P ratio SPA is 3, and the earning per share of CAPL is 39 rupees. So when you take the market value, I think even at the pre-scene level we discussed this, market based valuation is 936 million. So please note your market based valuation of the company is 936 million and the free cash flow valuation is 192 million. So this is the second method of valuation. Third one, net asset based valuation. This is purely your balance sheet total assets minus total liability. So 31st March 2022, the total assets of the company is 3.6 billion, it's in the pre-scene, 3.6 billion, and total liabilities is 1.4 billion and net assets 2.2 billion. So otherwise the equity of your balance sheet, you can look at the pre-scene, 2.2 billion. So 2.2 billion net assets is another method of valuation. Then the dividend valuation method. Dividend based valuation, they have said in the pre-scene, company is planning to pay 50 million a year dividend. 50 million a year dividend, company is planning to pay as per the pre-scene for next 5 years. If that is the case, we calculate dividend per share 6.25. Then how do you calculate the market value? We discount or basically divide by the required rate of return. The cost of equity we calculated is 28% and the CAPM model which is here, and dividend per share 6.25. Then a market price per share 22.32. Market price per share 22.32. Dividend based valuation give 179 million. So we have got four values of the company. You can see that one is free cash flow based valuation, second one is net asset based valuation, third one PE earnings method, fourth one dividend cash flow method. So the four methods of valuation we got. So we can go to the summary. So please note, these are the four methods of valuation. We have calculated free cash flow based valuation, market based valuation, and net asset based valuation, and dividend based valuation. So this is the total value of the company, this is the 20% share which is going to be issued, so this is the 20% share. So we look at the total value. Now see, free cash flow based valuation is giving 193 million. Market based valuation is giving 936 million. And net asset based valuation giving 2.2 billion, dividend based valuation 179 million. These are four values we have got. When you look at it, generally we all know that what is the best valuation method for a comprehensive method? Free cash flow method. So all of us know that free cash flow based valuation is the more comprehensive, more suitable, more fair valuation method. Second one would be price earning ratio method. But that is all on a normal circumstances. What do you mean normal? The economy is normal, where normal inflation rate, normal interest rate, all that exchange rate is normal. All this what you see over a normal historical period, that observation you have over the period is observed during the period. But if you are looking at a drastic changes in interest rate, inflation, exchange rate, all that, then you are not a normal condition. In that case, the question arises whether the free cash flow method is the method of valuation to value a company. Like a CFO mentioned, right, based on his knowledge, he has said free cash flow method is better method than a market based valuation. What we have to understand, the argument of free cash flow is a better method is valid provided your environment or the economic environment is normal. When you have like a kind of bankrupt level country or a crisis level country where your macroeconomic variables are significantly variation from your normal situation. In that case, you are going to depend on free cash flows, which is subject to many assumptions generally, right? The interest rates are, you assume at a normal rates, but your actual rates could be totally different in the market environment. Similarly, inflation rates, today's context, if you look at it, 70% inflation rate. So are we going to take 70%? Now in this case it is talking about 27, 70, something like that, 52% we take for second year. So this is at that time, this July paper. But your paper for December, you might have to understand that this could be different or worse than July paper environment. So if that is the case in terms of the inflationary impact and the exchange rate. So what do we do? These cash flows what we are going to forecast all based on assumption, these assumptions whether it's going to be valid or not valid. So I would say nobody could be saying what would be your inflation next year, what would be your interest rate next year, right? These are only a judgment or the estimate you could make, but there will be significant changes, not a small change, significant change could be there. So if that is the case, am I going to use the free cash flows and say this is the value of the company? I discount my free cash flow and say this is the value of the company, but it's going to be not right. Why? The free cash flow what you are forecasting is full of with assumption, and the assumptions, generally with the assumptions, but in this case the assumptions can vary, changes significantly or volatile significantly. So volatility is not in our control. So here the question is asking whether free cash flow based valuation is the method as we used to think as a better method. So here the free cash flow method gives you 192, market based valuation which is PE based 936, net asset based valuation 242, that means 2.2 billion, dividend based valuation 170. Normally we know out of the methods of valuation we use, generally normal condition the free cash flow method of valuation should give us a good value or the larger value. Why? Because you are looking at the future cash flows, we are looking at the future potential, future strategies, all things, all the good things, goodwill, brand image, location advantage and your potential of your company, all you look at it and see what's your future cash flow. So basically that free cash flows what you are forecasting, it will be based on all your strategies which are all positively we look at it and say these are the cash flow going to make. Based on that when you value a company, generally you get a larger value for free cash flow method. Whereas your net asset based valuation will be giving the lowest value. But due to the environment change, significant, drastic, I'm sure like none of us would have gone through these changes in our lifetime. The changes are so significant changes. It's almost double. Right? In that kind of situation, whether the free cash flow method will give you the highest value? No. Why? It's not about highest or lowest. The free cash flow method is not going to be solving a problem because your free cash flows are subject to many assumptions which are arbitrary and which can change drastically. So therefore, please note the free cash flow method in this case is giving you a lower value, which it's not because it's giving lower value we don't consider. It is giving free cash flow is giving you a lower value with so much of assumption and volatility, which basically we stop looking at it. So method in the environment like ours today in Sri Lanka, the method of valuation free cash flow may not be the right method of valuation. So better we look at any other alternative. What are the alternatives we have got? Dividend again, it's again based on the free cash flow, the profits that you are going to forecast. So better we do not look at dividend. So then we are left with two other methods in this case, market based and the net asset based. We should know that market based valuation again, it's based on PE ratio. P ratio of the company 3 times. How the stock market is behaving? We have been given a table how the stock market has began behaving in the past 1 year. Right from the last year to now, how the stock market behaves. So it has significant drop in terms of the market price movement, all share price index they were given here. So that we see that huge reduction in the all share price index and even the company SPA 380 to somewhere around 90. So that shows that it's a huge drop in the share market. In that case, your value based on the PE ratio, will it be giving you the fairer value for your company? True that It's the availability of the price earning ratio you value. But is it the more reasonable value? No. Then again, then the question comes, what is the better value in this scenario? So we come to net asset based valuation, which generally we think is the lowest value. We should not look at it because it's accounting based, it's not a fair value, it doesn't look at future, cash flows, strategies, all that. But in this case, compared to other methods of valuation, net asset method, not because it's larger value, it gives you a more fairer value because you have identifiable assets, identifiable liabilities at a price today's context. So in that case, your value could be better looked at net assets based valuation. Working number 15. So you can see the based on SPA Lanka details, market value of the CAPL is 2.6 billion, where 20% would be 527 million. Working 15. So you can see that they have used the market based valuation, the PE times of the 2021 value and the 31st March 2022. So based on the market based valuation, they say this is 936 to 2.6. However, this again we need to look at it, this is a 2021 value. So maybe it is a reasonable value because at that time the market was not having that impact of economy. So I would personally say that the value should be in the range of 2.2 billion to the 2.6 billion, right? More than the market price because it's not a price today, it's not available today. But your net asset is available today, so you could look at the net asset based valuation and have a base and compare to 2.6 billion. So it's more than 936 million because it is the lowest. So you can't say the value of 936 to 2.6 is a huge gap. So it should not be the so much of gap between these two because that's not a range generally you can think of. So then what is the value you are going to suggest to anybody to issue shares? So it's better that we take 2.2, 2.6 because 2.2 is your net assets based valuation and 2.6 is your based on December 2021 valuation. So you could think that okay, this could be a fairer value. So you can look at between the range of 2.2 to 2.6 billion rather than 936 to 2.6 billion. This is my personal advice, right? But normal circumstances, what is the best method of valuation? Again, free cash flow based valuation. It's not net asset based valuation. Net asset based valuation we generally give the lowest priority, lowest ranking. But in this case, we suggest that also to be looked at because your net assets today, if you take stock market, some of the companies, the good companies, net assets value is very much higher than market value. So that shows that why the market is not performing. The market is not performing, so the value of the market is lower than a net assets. But to be honest, then the company worth is more than a net assets. Company worth is more than net assets. Due to the overall macro picture, the values are undervalued. So these are the supporting points why the free cash flow based is superior. It is superior generally, but when it comes to the present condition, it is not superior. We should look at it because the superiority is challenged by the macroeconomic picture. Okay, that's 25 marks. So we discussed about it. C part. CFO does not agree with debt financing in the event. CFO does not agree with the debt financing in the event 20% fresh share issue is not possible immediately. That is in case because the market conditions are not good. We all realize that today market price is very low compared to December 2021. In that case, are we going to issue shares to public and raise money or the right issue or whatever we are going to issue or public IPO? Whether any company, today's context, should you go for IPO at this moment? No. Why? Your shares are going to be valued undervalued. Because market is down, your PE ratios are lower, so that you will value the share at a lower value. So do you want to value of yourself in the market lower? No, no one wants it. So maybe the IPO may not be possible, but The question says that CFO does not agree with the debt financing. In the event 20% fresh share issue is not possible immediately. So he is not agreeing with the debt financing also. I think we need to look at the matter 1, short term, medium term funding. CFO was concerned about meeting the funding requirement plan for the retail outlets, and he believes that there should be a backup plan in the event 20% fresh share issue is not possible due to disagreement in the share valuation. The chairman is of the view that debt financing is ideal as the company not sufficiently levered. Also, he is pointing out that cost of equity has gone up significantly in the market with the increase in market risk. So this is a short term, medium term funding the company is talking, where they say like if we can't go for the share issue and raise money, better we go with the debt financing because anyway the company low leveraged. So we have enough chance to improve our debt financing. So the question asks us, C part, provide your expert opinion on the comments made under matter 1, short and medium term funding requirement of CAPL if the 20% fresh share issue is not possible. Clearly indicate your recommendation with adequate justification. Please note whether we should go for debt financing or equity financing. And you are a company which is a low geared company, you are not high geared company, you are a low geared company, 29% we looked at earlier, right? So you are a low geared company and your share issue is not practical at this moment because market conditions are not good, share prices are undervalued, so no point in going to market and sell your share at a lower value. Why should you sell your product at a lower value in the market when the market is not conducive for your sale? So in that case, what do? Are we going to use debt financing or we look at any other alternative? Please note the advantage and disadvantage of the debt financing against share issue. Debt financing, we all know that the cost is cheaper, the cost of debt is cheaper. Even without the tax benefit, the cost of debt is cheaper than cost of equity. That means shareholder funds are expensive, debt funding is cheaper. So even in this case the same. So cost of debt is cheaper than the cost of equity. Then the question comes, then why should we take debt share money? We better take the debt money. Thing is, debt financing when you are going, first of all you need to find out whether your return you generate from your business is more than your cost of debt. As far as your return is more than cost of debt, you should go for debt financing provided you are under low geared company. But in this case, we need to look at whether we should go for debt financing or share funding. When you go for debt financing, what are other impact? Your risk increases, your cost of debt impact comes to a P&L, that's a risk impact. Then you need to have a regular cash outflow to make your capital repayment and interest repayment. If it is share issue money, you do not have a capital repayment or interest repayment. But if it is a share issue, if it is a debt issue, you have to pay regular interval cash payment for debt capital repayment and interest payments. So we need to be clear here whether we should go for debt financing. And you know that at 2022 March, the rates have been given, but then we all know that the market interest rates are increasing. Even the treasury bills rates are going up subsequent to March. So if that is going to go up, your cost of debt or the bank borrowing rates are also going up. Only thing, whatever loan you have taken already, that is not a problem because you are taken at the fixed interest rate before the 31st March 2022. But if you are going to borrow money after that, the interest rates have started increasing, bank also will charge you even the fixed interest rate at higher rates. So your cost of debt is going to go up and your repayments of capital and interest payments are there. Even the cost of debt can be cheaper than cost of equity, you need to know that you have a repayment issue because when you look at your future cash flows, your business will not be generating sufficient future cash flows because your environment is not conducive for business. There are many uncertainties, many volatilities, that expenses, inflations are there, that revenue we don't know, even though we are forecasting revenue will go up by so much. You need to understand that when the inflation is high in the country, the disposable income of the people comes down and then people will have limitation in purchasing the goods. So the goods purchases you are going to make will come down because your money what you are going to have in hand to buy goods and services will come down. Even if you go to buy the item, buy 5 items you bought in the last year, you will buy 2 items. So you don't buy the same number of items. So any products you take, your consuming power comes down. That means your demand for goods will come down. Even though we forecasted good revenue growth, but it may not be possible. Why? The entire country goes through the same issue, so the demand of the people will come down. That means the people do not have money to create the similar demand what they did it last year. So in that case, your future cash flows and future profitability will be uncertain, and lot of risk is involved. In that case, are you able to repay your loan? Even if you take new loans, are you able to repay your loan on timely basis? So there the question comes. So what do we do? What do we do? So the question, so you can see that your WACC 25%. However, the big question here to answer, is this the right time to commit to an interest cost? So they calculate your interest cover just to show that how the interest cover is. That basically shows whether your profits are sufficient to pay your debt cost. So your answer is, therefore we recommend CAPL to look for equity capital under current economic condition and delay debt capital until the macro condition improve. So very important is that generally, now see this question have challenged our normal knowledge where we think free cash flow is the best method. But here we have a challenge to say whether free cash flow is the best method, and we said no. And net asset basis we generally say don't consider. It's accounting base which gives the lowest value, don't look at it. But in this case that we looked at net as a basis, why? We realized that your future cash flows, future forecasts are not suitable in the present economic conditions. So what do? We have taken net as a basis also an important method of valuation in this case. Similarly, when it comes to the equity debt financing decision making, we generally say cost of debt is cheaper than cost of equity. So when you have a chance to borrow money, better borrow because it's cheaper cost, provided your return is better than cost of debt. So if the return is more than cost of debt, always borrow money and invest in your business. But in this case, even though company under low geared company, we recommend go for share issue. Why? Because you can't repay your interest cost and your capital repayment because your market environment is not, or the economic conditions are not good. So in that case, we are recommending that company should go for equity capital raising, even though the equity capital will have higher cost than the cost of debt, but there is no repayment of interest, there is no repayment of capital on a regular basis, so there is no pressure in your cash flows. So the other thing is, when a company is when the country is under economic crisis like what we have today, you do not increase your debt capital. You do not increase your commitments. Why? You do not know what's going to happen tomorrow. The entire world is going to go through recession period. So there is a demand will come down. And supply, even if it's there, people may not be able to buy it because income levels comes down. So if that is the case in a normal economy where the crisis is there or recession is there, try much as possible to reduce your spending, increase your earnings, and reduce your commitments on your capital expenditure, loan commitments, and various stuff. So better you reduce your commitments. Why? Otherwise you won't be able to have excess cash flow. You will be stuck. You will be forced to borrow further and further to do your survival. So please note that is the reason we say in the C part, better we go for equity financing than the debt financing. It's more than you going for debt financing, equity financing. I would say look at it or reconsider whether it's the right time for you to go for your expansion. Because when you say your expansion, it involves a lot of investment. And the investments, is it the right time you are making the investment? Because your investments are done at a higher cost. If you are putting a building today, you are building up at double the cost. So is it the right time to do it? Because then the return what you have to make for the double the investment cost, you need to earn. Then some will say that if you don't invest today, 2 years down the road, the cost of investment will be further higher than today. That may be true, but the thing is, are you going to earn money from that investment you are going to make? So unless you are very solid business where you will have your revenue cash flows enough to meet your expenses, I would say better reconsider your expansion plan. So therefore the expansion plan is to be considered before going to the financing decision, whether debt financing or equity financing. So investment decision is to be looked at again. Please look at that. Then the Roman number 2, explain how do you strategize the effective use of extra cash and cash equivalents of 7 billion held by Spa Lanka under the given macroeconomic condition together with a numerical example to support your strategy. So we looked at under unseen, the company they are given under matter 2, discussion with SPA Lanka, that's competitor, for investment in 20% CAPL shares. The business development team of CAPL together with PQR initiated a discussion with Spa Lanka as a backup plan in the event BRS is reluctant to invest further in CAPL. Discussion did not proceed positively, was planning for diversification. However, Spa Lanka PLC requested consulting service of PQR in relation to their investment in decision making. You could be seeing that they have got 7 billion money, 2 billion in the regular business, 5 billion in treasury bills. It's within 1 year cash flow, 1 year investment. So they have got 7 billion rupees and they are looking at 2 investment opportunity, hotel project and solar power project. 10 billion hotel project, solar project 12 billion. And IRR 13% and 12%. Now what is the question? Explain how would you strategize the effective use of extra cash or cash equivalent of 7 billion of the Spa Lanka under the given macroeconomic conditions with a numerical example. So please note, normal environment, if you are going to evaluate the investment decision, we have got say 7 billion rupees, what do? We look at the investment opportunity. So what is our evaluating criteria? We can use NPV, we can use payback, we can use IRR, various techniques. So here the question has given us the IRR, which is at 12%, 13% level, IRR given, and we have got 7 billion rupees to invest. Maybe the total project investment is 10 billion and 12 billion, but we are given 7 billion, so we may borrow some money and invest in the project if it's necessary. The question comes, what do? Whether we invest the 7 billion in this investment opportunity what we have got or not. Question is, what is your IRR? 12-13% IRR. And what's your cost of capital? So you need to know that what's your opportunity cost today. In Sri Lanka, the opportunity cost today is how much? Just think. I'm looking at today's context, that is in November, right? In the case study is in March 31st, 2022. But you look at what is your capacity? What is the capacity of earning today? The opportunity cost is how much? It's roughly 25 to 30%. 25 to 30% is the opportunity cost. You can put in a government security or fixed deposit and earn 25 to 30% easily. Without doing any business, nothing, 25 to 30%. So my question is, if you can earn 25 to 30% from a deposit or government securities, why do you want to move into an investment in a project, which can be a hotel project, which can be a solar project? Why do you want to get involved? So that's a question you need to ask. So the question comes again, the hotel project is, as you know, that it has its own risk because with the COVID, the tourism went down and then now it's starting picking up. So it's not very attractive at this moment to invest in the hotel project. Maybe time to come, yes, not today. So maybe delaying that is better. So under real option, as we know that the option of delaying would be valuable than investing today. So that is so you can see that you have option of investing in treasury bills or hotel project or solar project. So inflation they are given 20%, 47 levels, interest is at 17.4%. So when you go and invest in this time, that is this July paper, your interest is at 17.4, just they have taken average, inflation at 30 odd levels. So if you are talking about today context, the same thing, your interest is at around 30% level and your inflation is at the 70% level, double the whole thing. In that time, what do you do with your 7 billion money? Company will have a negative margin. Even at that time, company will have a negative margin for the income. Why? Because your inflation is higher than your interest rate. If you are under the Fisher's formula, we all know that Fisher's formula, your interest rate should be having two components, real interest rate and the inflation. Real interest rate and inflation. So when you add the real interest rate and inflation, you should know that your nominal interest rate should be higher than both of that. But in country today, our country, the inflation rate is around 70% and the interest rate is 30%. So your interest rate, what is nominal rate, is not even satisfying your inflationary impact. So your interest rate is not sufficient. That means you are going to have a negative return. So that's what they say, negative margin you will be getting for your investment if you invest in treasury bill or any investment opportunity. Then the question comes, what do we do with the projects? What is your project earning? IRR is 13 and 12, which is very much lower than your interest rates. So are we going to invest in a project at this level, 13 and 12? No, it's not. So what are options available? So the suggested answer talks about the alternative at this moment for you to buy back your own shares, That is because you realize that your share price is very much undervalued in the market. You can see that 2021 your market price was 380, today the price is 96. Significant drop your market price from 380 to 96. Even the index has almost doubled. Not double, it has come halfway. So after index and market price of your company is only 25% of your market price that you had in 2021 December. So that shows that your market is also not doing well and your company market price is also very low. So the suggested answer is talking about, since you have excess funds and it's not the right time to invest in treasury bill or bonds and it's not the right time to invest in the projects, so what do? So you buy back your shares because your price is very much lower. By buying back your shares, you increase or you reduce the number of shares and you increase your earning per share and you increase your market price. So your undervalued shares can become reasonably overvalued, not overvalued, it will be fairly valued in the marketplace. So that's one of the things the examiner is suggesting, that you can buy back your shares rather than investing in a negative return and lower return IRR giving projects. Better we buy back our own shares. Right. In addition, please understand that when you have a situation like that, whether we buy back the shares, is it the right time? Yes, it could be one solution. But there is another situation where maybe today context, it's not the right time for you to invest in new projects. But then you may look at the time to come, 1 year's time, 2 years' time, whether we can invest our money in the projects. But again, IRR of 12%, 13%, it's not at all satisfying your requirement. It's not satisfying any of the return requirement because 12, 13 very low return. So maybe it's not the right time, or it's not the right time, not more than the not right time. It's not to invest in these projects because it's giving very low return. But maybe the government security investment, yeah, we can for time being, because we have to invest somewhere if we have excess funds. If we don't buy back, we can go and invest in some government securities or longer term fixed deposits which will give you higher return. Because time to come, we know that interest rate has to come down or slow down as per the government of the central bank. It says that interest rate will come down over a period of time. So that's expectation. If that is to happen, we should be happy that our interest rate, if we can fix it for 5 years or longer period at higher interest rate, we will be able to earn higher income over the period, even though the market rates can come down over the second year or third year. So that is a good example. You would have seen the commercial bank debentures. It's a 5 years to 7 year period. Debentures were oversubscribed on the same day. That is because people want to fix their investment for a longer period at a higher rate. So when you fix it at a higher rate, even if the market rates come down second year, third year, fourth year, you would be able to earn higher income for your business. So that's the strategy should be to fix your high interest instruments and make sure that you get better income on the long run. Maybe a buyback is another strategy. You can look at it and you can think of postponing some of your projects so that you will look at the real value creation on a long run and then invest in the projects. Okay. Then the last part, the D part of the question. A concern was raised by the chairman about the decision already taken by the management of CAPL to go for an IPO in the year 22-23. So if you look at the matter 3, but they say the chairman has been warned by his colleagues that the minimum float requirement would entitle him and his immediate family member to dilute the current shareholding percentage in an IPO initiative. So please note that when you go for IPO, one of the concerns the family owned companies or family owned people have is that whether my ownership get diluted. Definitely it get diluted. When you go for the IPO, you have to accept that you cannot have the same percentage of ownership. It will come down. It has to come down because public is also becoming a shareholder in your company. So that is something chairman has been warned by somebody. So he needed a clarity before taking an action to go ahead with the IPO. Assume that you are the senior manager PQR, assigned as a consulting company, assigned to advise CAPL and Spa Lanka on the queries raised by them. So what's the question? A concern was raised by the chairman about the decision already taken by the management of CAPL to go for the IPO in 22-23. Explain the reason if you would recommend CAPL to go ahead with the IPO as originally planned. So the question is asking whether the company should go for IPO as they planned. So when you are looking at the IPO, right, equity financing method, when you compare to debt finance, there is equity financing method where you issue shares to public so that the shareholders or investor could become a investor in your company, and then they also share the profits of your company, a growth of your company, and the future, all the benefits to the shareholders can be there. Generally, the IPO requires following certain things. Firstly, the market has to be good. Market has to be good when you are going for share issue. Why? If the market is not good, you are going to value your share at lower value. Spa Lanka, if you look at it, 2021 December, the price is 380 and now the price is 90. So you can see a huge drop. At that time, are you going for share issue in the market? No. Why? That means you are going to issue the share at your 90 level of the, like a similar to Spa, you are going at 90 level. Whereas your share company, your value of the company is 380. So you are accepting my value is very low and going to market. So the market condition has to be very, very important. That's why there is a stable economic, social, political environment. So that's the overall market condition has to be very good. Active participation in the stock market. Please note the macro picture. When the interest rates are higher in the market, where do you invest? Where do you allocate your assets? Where do you allocate your money? Would you invest in interest-bearing instrument or alternative investments? If the interest rates are higher in the market, where do the people put the money? Fixed income securities. It could be government securities, it can be debentures, it can be long-term financial instrument which gives you interest. So everyone move into the interest-bearing instrument. Why the interests are very high? Today's context, people move to the interest-bearing instrument. Why? They get a higher return. Even though these are financial assets and value drops, people like to invest in interest-bearing instrument because it gives you higher return because you don't have other alternative. So then you move into look at the other options. What are other options? We generally have properties, real estate, land and buildings, and then you have the share market, that where you invest and then the share price appreciation gives you return. Then you get the gold, you may invest in vehicles and you may invest in other business opportunities or projects. So these are the things people would have done if they don't get a high interest bearing instrument. If you are giving 7%, 8%, that is 1 year back. In Sri Lanka, we were having 7.8% return. So where do people went? Unless you have a regulatory requirement, you try to move your monies to other alternatives, other investments. So what are other investments? As I mentioned, it could be property, it could be share market, it can be gold, it can be business, anything. So you shift your money, But in this case, where the interest rates are very high, very high in the market, where your government security giving 30%, fixed deposit giving 25 to 30%. So where do you put your money? Are you going to put into properties? Are you going to put your money into the business or projects? Are you going to buy the vehicles? Are you going to invest in share market? No. So there the demand for the share market activity comes down. Even though today prices are lower, but your opportunity cost is 30%. Your opportunity cost is 30%. Are you going to invest your money having opportunity cost of 30% in share market? That means what is your requirement? Government security being a risk-free investment is giving you 30%. So do you want to invest in share market, expect 30%? No. You want more than that, 40%, 50%. Whether the market can give you 40%, 50% in the short run? No. It has doubts. It has its doubts. So in that case, what do? Active participation in the stock market is not there in the market. People will be moving out from stock market going into government securities, fixed deposit, debentures. So if the money goes there, where is the money for the share market? Active participation comes down. Third, preferably a bull market. That's the market is doing good. So these three observations, if there is not, the IPO is not the right time to go. Second, internal, strong past performance, solid future forecast. You do not have that. You do not have a strong future forecast. We can forecast arbitrarily, but really looking at it, the market conditions are not good, economy is not doing well, people may not have enough demand for the products of ours. So then what will happen? Your revenue may not be there as you forecast, your profit may not be there for you as you forecast, then it's not a condition for you to go for IPO. So IPO needs certain prerequisites. That's what we have mentioned. So please understand, issue price can be set higher if all or most of the above conditions are positive. If it is not, unfortunately none of them seems to be positive. In these conditions, IPO is not a suitable solution to raise money. So therefore the company should postpone IPO and wait for the right time. So these are the things you should be looking at in IPO situation. It's just simply the equity financing, right? If you are aware of the equity financing, normal understanding of the theory, these are bonus marks. These are most bonus marks. The valuation chapter in this question 25 marks. It's actually you would have got net asset based evaluation correct, PE method evaluation you would have got, dividend also you would have got it. Only if at all it is a free cash flow method which would have taken time and maybe have certain complication. But otherwise all three methods are fine. But it's more than the calculation, you need to have logically in this condition macroeconomic picture, the free cash flow method is not the right method to value the company. So that's basically the question discussed. And the debt financing, again equity financing, generally we say debt financing is better, cheaper cost, but equity financing is better in this case. Why? You do not have a chance of repaying your capital and interest on a timely basis because the macroeconomic conditions are not good. So please note that this is the last paper of yours where 50 marks question. The majority of the marks is given for the valuation area and the capital structure and the equity financing. So these are the marks given for your this 50 marks question. So please be aware that as far as you are comfortable with your valuation chapter and the methods of valuation, you can score mark. Only thing you need to be clear here, wherever you are not clearly aware of some information in the question, you have got to make an assumption. Especially 50 marks question, you should have a list of assumptions. That's I think the suggested answer had a separate assumption list. So that assumptions have to be made. Okay, suggested answer is not something you need to memorize as such. You need to be guided by it. So it gives some idea what has to be looked at. Okay, so please go through all the areas whatever you would have learned for the last 5 months or 4.5 months and make sure that you are getting prepared sufficient to get through your exam. And please note December paper yours is also same or similar macroeconomic condition. Even though there is slight positivism, but to great extent we are similar to July extent. I would say July to now, some of the cost increase and interest rate increase are significantly more than what you have in July. So please note that similar environment is there. So similar discussion could be there in your paper also in terms of debt financing, equity financing, and your valuation chapter, free cash flow based valuation, and the share market buyback. All that could be there even in your December paper, because that doesn't change significantly from July to December. So please get ready with that mindset and be confident about your knowledge that you have gathered. It's only a short period for your exam. So be confident, be positive. Very important is that what you looked at in the past, don't worry about it. Maybe you would have failed previously. That doesn't make any relevance to your paper. So you need to be confident enough, and whatever work you have done up to now, make sure that you are clear about your theories, because study pack is a good material. Chartered Institute has done it, right? So you need to make use of the Chartered Institute study pack properly and get ready with the each and every area. Get ready with confidence that you are able to do it. And as I usually mention, question 1 and 2 you can score a lot of marks compared to question 3, because question 3 has lot of areas being tested and lot of reading, lot of time consuming is there. So but question 1 and 2 it has many parts, so you could be able to score some marks compared to question number 3. So end of the day your pass mark is 50 marks. So you try 80 marks, then only you get 50 marks, and you try to answer every part of your question rather than ignoring some other parts. Generally the time pressure is there for everyone. So make use of your time properly, because you should know question 1 and 2 totally we need 50 marks or 50 marks and 50% of your time, 1.5 hours. So 1.5 hours should be allocated question 1 and 2 rather than taking 2 hours for the question 3 or 2 hours for the question 1 and 2. So it should be properly allocated, and make sure that you attempt most of the questions. Sometimes the last parts are easier, like here also the 4 marks, 8 marks questions where you can get more marks than your first parts. Valuation may be taking longer time, longer the working you have to do rather than question last 2 parts. So you can score more marks than the latter part. So please read all your parts properly, because I think 15 marks is given, 15 minutes is given for your reading time. Get ready and make sure that you are clear. Each one is different. So your time, your ability and your confidence could be different to another person. So you attempt based on your confidence, which is better, and get always positively the good. You are confident on some area. Try to get the marks on that area before going to unknown area. Right? If the question is asking about something unknown to you, don't waste time in doing that part. Rather you do it with the confidence some parts, because then your motivation level, morale level at the exam all increases. So you are able to earn more marks and then get through exam. Okay, thank you very much, Sri Lanka, for the opportunity given. All the very best for all of you all to a good job at the exam. Thank you.